The reason it's felt so bad for folks, I think there's many stories of people's accounts being wiped out. Maybe the price hasn't really reflected the mass liquidations that have taken place. I think in the back of people's minds, they've been thinking there's a 4-year cycle. When everyone carries a hammer, then all they see is nails. As much as people have been excited about AI and quantum, I think quantum is kind of viewed as quantum progress is seen as a threat to crypto. Too many people that do equities think, hey, a company has great earnings, the stock should go up. Inflation's high, so stocks should go down. The ISM's below 50, so we should be in a bear market. Those things rarely explain what stocks do. The Fed isn't really dovish. The odds of a December cut had dropped. They went from 70%, dropped to like 30, and are back to 67. That's show you that there is so much uncertainty around monetary policy. There probably was leverage being built up in the system, in equities and in crypto. And so we're just seeing a leverage reset.
Tom Lee opens with a snapshot of today's markets, where both equity and crypto investors are feeling the pressure. Uncertainty around Fed policy, political tensions, and stretched growth valuations have shaken confidence, leading to pullbacks in popular AI, quantum, and tech names. Crypto, once again, has felt the impact more sharply. Tom highlights a few key reasons behind the weakness. Many investors are anchored to the idea of a 4-year cycle, interpreting every move through that lens. At the same time, new technologies like quantum computing have introduced fresh questions for crypto, while widespread liquidations have quietly wiped out leverage and accounts pain that isn't fully reflected in prices. Before we continue, please like the video, subscribe, and turn on notifications so you don't miss future updates. Check out our other crypto content and share your thoughts in the comments. Let's get into it.
I think that the reason it's felt so bad for folks is, number one, I think there's three things, many more than three. But number one, I think in the back of people's minds, they've been thinking there's a 4-year cycle. And so, as you know, when everyone carries a hammer, then all they see is nails. So in their minds, everything that's happening is confirming that we're in a 4-year cycle. And I've had a lot of people show me that chart, the 391 days, right? 1,064 days of gains and then 364 days of declines. And that's number one. So it's the pattern recognition in people's minds. I think the second is, as much as people have been excited about AI and quantum, I think quantum is kind of viewed as quantum progress is seen as a threat to crypto. Or crypto hasn't figured out whether it's good or bad for crypto. Because as you know, there's a lot of people talking about the encryption risk for Bitcoin and other cryptos because of quantum. And the third reason I think it's felt worse, Frank, is maybe the price hasn't really reflected the mass liquidations that have taken place. I think is maybe the reality, is that Bitcoin and Ethereum have held up really well. But I think there's many stories of people's accounts being wiped out. As you know, I have a long history in macro and looking at markets. And if we look at risk assets in general, I think people become overly tied to a narrative and simplicity, thinking that explains markets. Like, for instance, I think too many people that do equities think, hey, a company has great earnings, the stock should go up. Or they'll be like, inflation's high, so stocks should go down. Or, the ISM's below 50, so we should be in a bear market. But as many people who try to understand macro know that those things rarely explain what stocks do. And so you're right. So as crypto starts to have more macro and institutional investors and then be tied to money flows, the price of crypto won't always make sense, but if someone, if I was just to make some casual observations, Since late October, a lot of the things that have corrected in risk markets have been the things that did really well this year. So like the AI stocks have sold off, the nuclear names have sold off, the quantum names. So these are, they've been very popular with hedge funds and retail investors. And they've had what you'd say is their price has outperformed the expectations around earnings growth. So basically the risk premium has fallen or their multiples have gone up. So that's what's derated. And if someone asks me why things have derated, I think it actually is just possibly a couple of things. One is the Fed isn't really dovish. I mean, the Fed, people haven't decided, and the Fed still hasn't decided if we're in a disinflation cycle.
Yeah.
And if we are, they should be cutting. But like, as you know, every Fed meeting is a coin toss. I mean, look at in the last week, the odds of a December cut had dropped. They went from 70%, dropped to like 30, and are back to 67. I mean, that's for Fed cutting in December and this close to December. The fact that probabilities have moved that much show you that there is so much uncertainty around monetary policy. And as you just kind of described, the current White House and the president is very divisive because there are those who didn't vote for him. And for whatever reason, this White House has really become a lightning rod for divisive and dissent. I mean, there was even last week some military members suggesting they should disobey orders from their commanders. I mean, that's very politically divided. And the third is there probably was leverage being built up in the system. I mean, in equities and in crypto. And so we're just seeing a leverage reset. I don't know if that really helps, but I mean, I'd say that those are contributing to like why crypto probably isn't performing as well as we think, because you're exactly right. There's so much building being done. And actually we know that there is so much being built by Wall Street wanting to actually embrace and build on the blockchain. So, does that mean crypto is broken, or are we in a period of time where the fundamentals are doing better than the equities? I mean, I think that's where we are right now. I think that there's a flaw that most people make when I see crypto projects and people talk about crypto tokenomics or crypto economies or whatever economic model, which is that they have static assumptions. They'll say, oh, look, Tom, there's all this stable coin growth and there's all these L2s, but they're not generating fees for the L1. So therefore the L1 doesn't accrue value. That is the same as someone saying in Facebook, okay, when Facebook launched mobile and they said, well, Facebook, you're not charging any money for people to actually do mobile. You're actually just, it was free on the desktop, it's free on the mobile. And maybe you can sell 10% more ads on mobile, so therefore it's not really beneficial to Facebook. Do you realize how wrong people were about that assumption, right? Because basically Facebook is a UGI company. So the more people that use it, the more valuable it became as a platform for advertising. And of course, the network effects kicked in. And then today, Facebook dominates all the advertising business, but that was not evident in 2007. L2s, it may make sense, especially on Ethereum, to let the L2s grow, create a huge ecosystem, and not charge direct proportionate gas fees. Because if this is where everything is going to be built, then the L2 is going to accrue significant value. I think that I think it's really absurd when people say you could have 10 trillion of stable coins and it's not going to benefit ETH because look, they're not charging any fees for that. that's basically Facebook's strategy, right? In 2007, they want to become the standard. So they really want everything to scale, and then they can always modify this business model later to accrue value to the L1. I think it's a perfect example of how, and I've seen this, the people who are an expert in a prior regime always think that they're an expert of the future. Okay. That's like when I did wireless in the early 90s, and everyone has this problem. So and including myself, but in the early 90s, when I did wireless, okay, wireless was 34 million cell phones. And these companies that were cellular had to buy spectrum, which was expensive, or acquire spectrum through mergers or other ways, like some got it through the Catholic Church. Then they had to build networks that cost $50 per person of infrastructure. Like, so to build the entire country, you had to have billions of dollars, okay? And then you had to charge money for the service. But then you had to get people to buy a handset, okay? So in the 90s, everybody I met that was a money manager and really established, the vast majority said the cellular industry is going to fail because the long distance industry is powerful. The local telephone companies are powerful. They're not going to let cellular succeed. In fact, they're going to keep making cellular and undercut pricing so that cellular becomes a free service. So number one, that's the incumbency. People saw that the long distance telecom companies had all the money, and these are 50-year-old people. They probably barely found utility in a cell phone anyways, but young people saw cell phones very differently. And not only that, as cell phones grew, it transformed communications and it became bigger than gaming, media, landline, cable combined, because there were so many, not only network effects from owning a lot of users, but you created a whole vast array of new services, including mobile advertising. So if an Ethereum blockchain captures 70% of all RWA and someone says it's not going to benefit Ethereum, that is someone who actually is using the same logic to say new technologies and new applications don't benefit the new entrants. In fact, as you know, there's a lot of people in Bitcoin that don't think there's anything other than Bitcoin that exists. I mean, there's so much tribalism.
Yeah.
And when people say L2s don't benefit L1s, that's a tribal view. I'd say it's, I've had the same people that tell me in the macro world, S&P shouldn't go up. The AI stocks are expensive. Quantum makes no sense. I've heard every negative argument for the stock market for 30 years. And I think people get into the same trap. Just because they have expertise in one domain or even one regime doesn't mean that they're going to be the dominant mindset for the next regime. It's really an important thing. I think people really need to open their eyes. And in fact, even as people are putting and writing the obituaries for DATs, they're forgetting that a couple of these are really going to be transformational businesses. But the vast majority were just experiments.
A key takeaway from Tom Lee's analysis is that the market feels far worse than the price action suggests. He argues that investor psychology, especially belief in a rigid 4-year cycle, is driving sentiment, causing many to interpret every move as confirmation of a deeper downturn. Tom points to several pressures, including mass liquidations, leverage resets, and growing macro influence from Fed uncertainty and political tension. Unlike past cycles, crypto is no longer isolated and is now increasingly tied to institutional flows and broader risk markets. Despite the stress, Tom remains constructive. Bitcoin and Ethereum have held up well, leverage is being flushed out, and continued building across blockchain infrastructure suggests improving long-term fundamentals. If you're enjoying the analysis, don't forget to like the video, subscribe, and turn on notifications.